All right, so we're going to talk about TICs today. Done a couple of classes on these already, but we'll talk about tenants in common ownership works and what buyers must understand before financing one. So, big question. So TIC is condo. No, it's not. It may look and function like a condo in everyday life, but you may occupy one specific unit. You may remodel your own interior. You may sell your ownership interest separately. You have separate financing, but legally, multiple owners share title to one parcel. Your exclusive right to occupy a particular unit kind of comes from the TIC agreement, not from a separately deeded condominium unit. So that's the difference. And the difference often affects financing, taxes, insurance, resale, and risk. So here's our roadmap today. Understand TIC ownership, financing, reviewing the property, managing the relationship, and long-term strategy. So let's start with the truth. TICs is a relationship as much as property. It's true. When you buy TIC interest, you're not only evaluating unit, location, price, payment, but you're also evaluating co-owners, TIC agreement, buildings, finances, insurance, shared obligations, and then you want to make sure that you're gonna be okay with decision-making process, default provisions, resale structure. So what is a TIC? So it's a common form of co-ownership where it's two or more people own undivided interest in same property. Equal percentages, unequal percentages are often the case. If you buy a two unit, someone else has one unit, it's different percentage, right? Separate financing. So, so keep in mind, owner A, 40%, owner B, 35%, owner C, right? They're all together 100% of that particular parcel. So what does undivided interest mean? So assume it's a 3 unit building, you purchase 35% of that common interest. So you have 35% undivided interest in the entire parcel. So that is one thing that you have. It doesn't say that your exclusive right to occupy unit two, right? It's a percentage of the parcel is how it's vested. Owner owns number two. So TIC versus condominium condo. Owner receives title to the separately defined unit. Owner also owns interest in common areas. Each unit is generally a separate parcel, has its own tax bill. So it's broad with FHA, VA, conventional financing. TIC, owners share one parcel. Occupancy rights are generally created by a private agreement. The building may receive one property tax bill. Financing is available through a smaller group of lenders. There's five that we work with. Co-ownership agreement becomes extremely important. So TIC should not be written as if it's simply a cheaper condo. So TIC versus co-op. TIC, owners hold direct interest in real property. A co-op is a corporation or entity that owns a property, and then shared interest condo, the resident owns separately deeded unit. So why are TICs common places like San Francisco? Well, because they allowed multiple buyers to purchase interest in multifamily properties without first screening legally separate condominium units. The attractions are lower priced, comparable condo, access to desirable neighborhoods, larger, more distinctive units, entry into buildings that were not converted to condos, and then, of course, there's potential conversion in limited circumstances. So the drawbacks are more complex financing, share legal and financial agreements, fewer lenders. At times, it can be a more complicated resale and conversion uncertainty. So the TIC agreement, well-drafted TIC agreement would address ownership percentages, exclusive occupancy assignments, common areas, monthly expenses, taxes, insurance, repairs, capital improvements, voting rights, refinancing, sale rights, transfer restrictions, defaults, dispute resolution, buyer buyout rights, death or incapacity, condo conversion. The agreement's operating system for the building. Straight short. Exclusive occupancy rights, why you can live in your unit, because the TIC agreement generally assigns each owner the exclusive right to occupy a specific portion of the property. So the agreement may identify the location, storage, parking, decks, gardens, common hallways. What are your percentages? Why does one owner have 42, the another 28? And so this is because unit size, purchase price, location within the building, parking, right? The percentage may affect property taxes, insurance, common expenses, major repairs, loan amounts, voting rights. So ownership percentage and monthly expense percentage may not always be identical. So how property taxes work? San Francisco generally treats the TIC property as one parcel. for property tax billing. Los Angeles, very similar, actually the same. State of California, right? So a TIC agreement may allocate the bill based on ownership percentage, agreed allocation, unit value, potential value. One owner's late payment may affect the entire parcel. So the protections are essential payment account, automatic payments, reserve account, default remedies. Property tax reassessment. One TIC interest transfers, the assessor may evaluate the change in ownership. The result affects the owner's tax burden, tax bill, tax supplements. So the questions that address are how will the reassessment be calculated? Who pays supplemental taxes? How will the master tax bill be divided? Does the agreement contain an allocation method? So what's a fractional TIC loan? Fractional TIC loan is generally made to an individual owner secured by the owner's undivided interest in the property. Benefits are each owner has a separate loan. One may refinance without refinancing every co-owner, and the owner's mortgage is potentially separate. Limitations for lenders, higher rates, lower down payments, more legal review, be a little bit more difficult. So what's a group loan? All owners may be borrowers. The entire property secures one loan. It's a lot easier to do it that way. Historically, broader access in some periods, one building level loan. All owners are tied to the same mortgage. One owner's default can affect everybody. Selling one interest can be complicated, right? Refinancing generally requires broad cooperation, and owners may remain liable for the entire debt. So fractional versus group loan is a comparison between the two. Separate borrower, separate promissory note, lien against their interest, individual refinance may be possible. A group loan, multiple borrowers, one mortgage, entire partial secures the debt, shared default risk, a lot more risky. So before buying a TIC, identify the existing loan structure of the building itself. So can one owner's default affect everyone? Fractional structure, defaulting owners may be the primary collateral, but foreclosure or enforcement can still create legal cost, pardon, ownership disruption, new co-owner risk, building management problems. Group loan, miscontribution can jeopardize the payment on the entire mortgage, and all the other owners may need to cover that shortage. So how a TIC loan is underwritten. We look at income, assets, employment reserve, debt obligations, right? We look at the appraisal. We look at the TIC agreement, title insurance, building condition, right? Under occupancy structure. So a strong borrower cannot cure a structurally unacceptable transaction. Keep that in mind. So credit requirements. Credit may affect interest rate, loan to value, down payment, reserve requirements. Potential concerns there would be recent late payments, bankruptcy, short sale, right? Dispute accounts. TIC lenders may have a narrower exception authority than broad conventional lenders because it's a harder loan to do. There's fewer lenders doing them. So down payment. Usually 10, 15% at a minimum. We tend to see 20 to 25% down, more depending on the program as well, documentation type. But requirements may vary on occupancy, credit score, loan amount, property size, right? So there's not a one fit all thing there. So don't assume a TIC qualifies for the same low down payment options as a condo or an FHA transaction. They're different there. So reserves, Going personal liquidity matter, the lender may review borrower reserves. We do want to see 6 months on a TIC. Post-closing liquidity, which is that building reserve account, upcoming repairs, contributions. And so it may increase when the property is older, the loan amount is larger, the borrower owns more than one property, building has limited reserves. Occupancy. So loan options may differ for owner-occupied versus second home or investment properties. There are DSCR loans where you use the income of the property if it's a rental to help qualify it, but keep in mind that could affect the rates, reserve requirement, rental income analysis, right? These things come up. So confirm occupancy eligibility before writing the offer. TIC appraisals, what's being appraised? The entire property, the subject ownership interest, the assigned unit, TIC sales, location, condition, right? So the value of TIC interest may not equal the same percentage of the building's value. So TIC comparable sales, appraisals can be challenging. So if there's very few TIC sales, it's hard to come up with that value. So what we want to do is use TIC comparables, condos with adjustments, multifamily data, building level information. So a beautiful unit can still be difficult to value when the ownership structure is unusual. So TIC discount versus condo value, the monthly payment comparison, we have condo, TIC, and then showing the differences thereof. So higher purchase price on a condo, potentially lower mortgage rate, more loan choices. TIC, lower purchase price, potentially higher mortgage rate, fewer loan choices. So insurance. So keep in mind with insuring a property, you have one building, multiple owners, multiple coverage questions. So potential policies may include building level master insurance, which covers the entire building, individual unit contents, which is what we call an HO6, covers your belongings and inside of your specific ownership percentage and unit. Liability coverage, earthquake, may be required, flood. So the lender may evaluate the named insured's mortgage clauses, right, which is where we put our information on that as well and make sure that's updated for the master as well, master insurance policy. So insurance must match the ownership and loan structure. Long story short. Master policy versus individual. Building policies, the structure, common areas, individual inside the property, right? So that's the biggest thing to think about there. Questions: who pays a premium, house deductible, divided, weapons after major loss, and who controls the claim. So building condition, this is a big one we want to know. Foundation, roof, exterior, plumbing, sewer lateral, sewer, right? Retaining walls. Well, make sure it's good. So leaking roof may be above somebody else's unit, but the expense may belong to everybody. Keep that in mind. So capital improvements, who decides what gets fixed, right? This roof, foundation, exterior painting, window replacement, right? These are things that you want to find out when you purchase a property. Building reserves, how much is set aside? Did you deferred maintenance, capital projects, right? The absence of HOA doesn't mean the absence of future expenses. Keep this in mind. You want to see what sort of reserves are available for this particular property. Where are you paying into? So shared utilities, who pays for what? So these are the questions you ask. Are utilities separately metered? How are shared costs allocated? What happens if usage is unequal? Who maintains shared systems? So the monthly TIC obligation may include more than a loan payment and taxes. So parking, storage, and outdoor space, right? Confirm the rights in writing. Exclusive use should be documented, not assumed. So you want to get in writing. You want to make sure you have an agreement, right? For parking spaces or if there's garage access, storage rooms, decks, what have you. Legal unit status, is a space a legal dwelling unit? So you want to review the certificate of occupancy, building permits, planning records, right? Consequences, if not, appraisal problems, insurance issues, financing limitations. Beautiful finishes do not legalize an unauthorized unit. So tenant occupied TICs. Existing tenants can change the transaction. Lease terms, rent control status, these are the things you want to find out. So TIC financing cannot erase landlord-tenant law. Owner occupancy history. So why does it matter? Occupancy history may affect tenant rights, future use, resale disclosures, right? So it's important to review who lives in each unit, how long have they occupied it, were prior tenants displaced, or buyouts completed, are required notices available. So the property's legal history can be as important as the physical condition of the property itself. The Ellis Act and eviction history. This requires legal review. I'm not an attorney, but one thing we do want to share with you is make sure you do some diligence and review and find out, right? You're going to want to get legal advice if TIC properties have Ellis Act withdrawals, owner movement evictions, tenant buyouts, right? These could be concerns. You want to look into those. DRE public report. So when might a public report matter? California Department of Real Estate rules may require public report for certain initial TIC marketing and sales. So you'd have to review ownership documents, TIC agreement disclosures, property condition. The seller and listing team should confirm whether DRE requirements apply. So title review. What's the buyer actually receiving? Title review is going to show you essentially the deed, loan, right? And the history of any liens, judgments, easements, restrictions. So title questions here are, does the percentage match the contract? Can interest be separately financed? Will existing liens be released? Existing group loans. Can the buyer obtain a new fractional loan? Potential complications would be the entire purchase or collateral for one mortgage. The existing lender must be paid or consent to more financing. Other owners may need to refinance. So a sale may trigger group refinance, loan assumption, payoff, restructuring, and subordination. So identify existing debt before promising fractional financing is important for any lender. Refinancing fractional TIC loan. Can one owner refinance loan? Yes, depending on the loan structure, TIC agreement, lender requirements, right? These are things that we look at. And you want to show that it's going to be some sort of improvement. Lower rate, change the loan term, cash out, removing somebody, right? So separate financing creates flexibility, but the building documents still matter. So cash out refinance, again, this may be valuable, but remember, like any other asset or real estate, a home is not an ATM. So you want to make sure that, we look at the reasons why for refinance, but valuations can be conservative, often a lower loan to value for cash out. There needs to be agreement, or there may be agreement restrictions with the TIC agreement as well, right? So it depends on why you're refinancing. You can do it for home improvements, business needs, investment, liquidity, as you see on the left there. So selling at TIC interest, the buyer pool is smaller, and potential resale considerations would be looking at who's lending, what are the rates, how quick do they close, what's the unit condition, building reserves, right? All the things again, right? If you're looking to sell at TIC. So first right of refusal, the other owners match offer. Some TIC agreements may give co-owners first right of refusal right to approved buyer. So you want to review notice periods, required documentation, waiver procedure. So transfer restrictions protect the group, but they could also delay a sale. So be aware of that. So bias between co-owners. What if one owner wants more space or wants out? So buy issues may include value of interest, appraisal method, qualification, right? So a handshake is not a buyout plan, right? So most of the stuff, actually all of it, you want to document properly. Death, divorce, or incapacity, life events affect the ownership group. The agreement should address death of an owner, inheritance, estate transfer, right? Divorce, bankruptcy, incapacity, credit claims. So estate planning matters when ownership is shared. Dispute resolution. What happens when owners disagree? Procedures, owner meeting, written notice, voting. The TIC agreement is going to spell this out, but mediation, arbitration may be part, right? Court action even. So the agreement should provide a process for dispute occurs. And common disputes would be repairs, noise, pets, remodeling, shared expenses, parking. So partition risk. Can an owner force to sell property under a general coercion bond? A tenant in common may have partition rights. A well-drafted TIC agreement may address and restrict how those rights are exercised, subject to applicable law. So again, that's where you'd want to contact an attorney, real estate attorney, and find that out. But the ability to share ownership peacefully should not depend on everyone remaining best friends forever. Can a TIC become a condo? Potentially, but never assume it will, right? Because there's all these things that go into condo. So conversion is a possible future event, but not a guaranteed value today. So condo conversion value. Upside could be significant. So now you have separate deeded units, broader financing options, larger buyer pool, right? But it requires time, legal work, surveying, construction, code upgrades, a lot of things. So do not pay today for conversion that may never occur. Conversion financing, what happens to the TIC loans? After legal conversions, owners may need to refinance their fractional loans, release existing liens, obtain new condo loans, obviously, right? And so the closing sequence would require multiple lenders, escrow coordination, attorney involvement, appraisals, right? Conversion is a legal project and a financing project. So TIC is a primary residence, potential benefits and risks. Benefits, lower entry price, desirable location, distinctive architecture, larger unit. Risks, complex financing, higher rate, larger down payment, co-owner dependence, shield building expenses. The right buyer values the property and understands the structure. Investment, TIC financing. So long-term rental, keep in mind, partial building ownership, portfolio diversification makes sense. Acquisition, right? So these things are good. Challenges, limited investment fractional programs. We do quite a few of them, candidly, but keep in mind, requires a higher down payment. We are going to look at rental income analysis, right? And in investment, candidly, as it says at the bottom here, TIC should be evaluated as both a rental business and a shared ownership arrangement and agreement. So it's important to have both in that case. Hard to do is an investment candidly, but we've done quite a few of them. So rental income, how's it calculated? Current lease, market rents from the appraisal. And, we're going to look at essentially the entire project. Again, shared expenses, maintenance, right? The rent from one unit must be evaluated with the economics of the entire property. So Airbnb and short-term rentals, do not assume that they are allowed, right? Keep this in mind. So you want to make sure it's allowed. San Francisco or Los Angeles or even in San Diego. You want to make sure it's registered if there's registration requirements, right? You want to make sure that you meet the primary residence rules. If there's any restrictions, you want to make sure that you get ahead of those. So the online revenue estimate means nothing if its use is prohibited. So what buyers should review? TIC agreement amendments, title report, existing loan information, tax bills, tax allocation. You want to see the budget. You want to see the balance sheet. You want to see repair history, meeting notes, right? There's a list here, but do not review only the unit. Review the ownership system. So what sellers should prepare if you're selling a TIC, gather your TIC agreement, ownership schedule, occupancy, assignment, floor plan, any rights to parking or storage, right? You want to have reserve statements, repair documentation, permits. This is the list for you. So a prepared TIC listing is easier to finance and easier to trust. So what listing agents should do? Reduce uncertainty before the offer. Confirm what percentage is being sold, what space is assigned, is financing fractional or group, which TIC lenders are active and can assist, what down payment may be accepted. Are documents complete? Is there an existing lien issue? Are co-owners cooperative? Taxes current? Right? So don't advertise a TIC as just like a condo. It's not. Similar, but it's not a condo. Comparison. What buyer's agent should do. Coordinate with the experienced TIC lender, TIC attorney, title and escrow, right? You want to review agreement, loan structure, appraisal risk, resale market. So the buyer needs a TIC team, not just a purchase contract. How to write a strong TIC offer. Financing certainly matters. So have the buyer get underwritten early. We like to get our buyers underwritten before they make an offer. So you send the TIC agreement to lender before offering. If able, confirm fractional loan eligibility. The lender, our team generally will go through and review payment, go over realistic contingencies, and when the offer is made, we'll call listing agent and talk about how strong the buyer is. So a strong TIC offer begins with document review, not a generic pre-approved letter. It's different, very different. TIC financing timeline. Before offer, bar approval, agreement approval, preliminary property review. After acceptance, get started. Fully underwritten. If it's not ready, get those conditions, review legal documentation, billing, finance review, final approval, get those remaining conditions, work it clear to close, agreement approval, lien, and title clearance, and then loan docs go to escrow, fund record, occupancy transfer. So the big 12 mistakes we tend to see, avoid these. Treating a TIC as a condo, ignoring building reserves, reviewing only the assigned unit, assuming condo conversion is guaranteed, ignoring the TIC agreement, failing to review tenant and eviction history, assuming every lender finds his fractional interests. We get a lot of clients that were pre-approved for months and months and months just to find out they were told they could do it, told they could do it, they were told to do it, and then we ended up helping them do it, right? So don't do that. Accepting informal parking or storage rights, getting in writing, failing to identify a group loan, ignoring co-owner default provisions, underestimating tax and insurance, closing the property before confirming financing. Discount is not worth it when structure is misunderstood. Primary residence TIC. So San Francisco, we do more in LA than San Francisco these days. But with the buyer, we're going to look at strong income, excellent credit, significant down payment, buyer closed with fractional financing, right? So there's a great buyer. We've done 18 of these in the last 12 months. So what we did was they knew, they referred to us that we could do fractional financing. We reviewed the TIC agreement early. 100% was secured, insurance accepted is fine, taxes were set up, and then a well-documented TIC loan in this case is financed smoothly when the review begins early. So here's a case study, group loan problem. The buyer wanted fractional financing. So listing a period to offer separately financed TIC interest. Title review showed the property was secured by one mortgage. The existing loan could not remain while the buyer had a fractional loan. So The result here was existing debt structure controlled the entire sale until it was resolved. So the solutions here were pay off the group loan, refinance every owner into fractional loans, restructure the sale, use an improved assumption when available, and then delay the transaction. Lesson here is the existing debt structure can control the entire sale. It's important to know. So not under TIC. This is actually in Los Angeles, but there's limited investors. So the challenges were that there's limited investors that'll do these things. So we had a buyer who's buying for her daughter, and it's in Los Angeles. She lived in Orange County, and she was putting 30% down, and we qualified it because her daughter wanted investment. They went on in it together, and mother and daughter bought it. They formed an LLC, which was approved. We had to approve that. They offered, as I mentioned, larger down payment. We used the income of the property to qualify it using what they call a DSCR loan, which uses the income to qualify the rental, and it's still rental today. And the daughter has a property in her name. Her mom helped her co-sign for it. So owner-occupied investment TICs are not in the same lending market. Long story short, there's only one investor that's able to do it, and it worked out. So here's the TIC buyer playbook. Confirm the assigned occupancy area, review insurance, obtain the complete TIC agreement, inspect the entire building, identify fractional and group financing, review reserves and upcoming repairs, review title and existing liens, investigate legal unit permit history, confirm lender eligibility, review tenant and eviction history, calculate realistic down payment, treat conversion as uncertain, estimate future property taxes, and complete legal and lending review before removing contingencies. So if you want to build your financing plan, we'd love to help. We want to set that dream call with you and go over it. So we won't find a property address if you know. If you don't, that's fine. Let's get a call to discuss where you're looking to purchase. Are you looking at fractional or group financing? Will the property be owner or occupied or rented, right? These are all things that we want to go over with you in great detail. And, come back and answer any questions beyond the scope of this presentation. So there's my contact information. You could also see in the captions a link to schedule a call with me. Love to talk with you and go over this in great detail.